Welcome back to the channel of Truth, Trust and Transparency. Today I'm reviewing a suburb from our YouTube audience. Someone has asked me, Dave, can you please review Mill Park and tell me your thoughts? It has grown more than 3.5% in the last 6 months. Can you do a suburb review of properties in Mill Park? So I'm going to tell you what my thoughts are on Mill Park, whether or not I would invest there, what are the opportunities, have a look at the data, have a look at a little bit of around a few of the mapping overlays and opportunities, and tell you if I think I would invest there. So let's dive straight into it, shall we? Okay, so if you're watching this video and you're thinking, Dave, where the hell is Mill Park? I first like to use Google Maps to orientate myself. So Mill Park is northeast of Melbourne CBD. Let's see the distance to. You're looking around 36 Ks to the city, 45 minutes. Not too bad. Not too bad in terms of that location, but that's where it sits. The first and foremost, what I want to do is I want to look at the data. I want to look at why is Mill Park doing that sort of growth. Let's have a look at the data, shall we? Now that we know the position of it. So I jump into the data. As you guys know, I'm using the H-tag platform for this initial assessment. Tigwell price is $950, about $799 for 3 bedders, 4 bedders are $976, and then 5 bedders are just over $1 million. Very decent on risk scores, capital growth, and those sorts of things. Cash flow, obviously, as we know, in those more expensive pockets, the yield starts to drop off, which means the cash flow drops off too, and we need to be putting more money towards these. So these type of suburbs at that price point is more a capital growth play than they are a play about cash flow. Decent sized population, as always, no real bushfire or any of that risk. Now, one of the things that I noticed straight away was the growth rate cycle of Mill Park would be a very interesting story. Again, we cannot make a decision based on past growth, but we can use that to inform us to make a predicted and informed decision. We don't have the future data, so we can't predict what it's going to be like in the future. Again, one thing that concerns me looking at the past performance is that we have three instances where the growth rate cycle has dipped below 0%, so it's going negative, it's going backwards. So the suburb is a bit of a roller coaster. So when it's like that, it's not a steady, if for this particular circumstance, you're looking for a long, steady performer, you don't have that steadiness of that growth rate to be going, returning you that average 5, because it might be up some years, it might be down. So it makes it harder to be able to predict what it's going to do. Are you getting in here to ride the wave up to the top and then sell before it dips below, or are you going to just try to ride that wave? So for me, that's a little bit of an amber flag. I'm looking at it thinking like, ooh, it's not giving me reassurance that it's going to be a steady performer. I might get some years at 10, I might get some years at -3, which isn't ideal as a property investor. However, nonetheless, let's look at the rest of the data. First is going to be ERSAD score. So we're bang on middle of ERSAD. As we know, 1 is the lowest socioeconomic area. 10 is the most affluent, bang in the middle. A typical rent-to-owner ratio, nothing too overly bad in terms of percentage-wise. We'd expect that in an ERSAD of 5. Sales and rental volume, there is a lot of volume there, which is great. There is also potential arbitrage between 3 and 4 bedrooms, i.e. 3-bedroom converted to a 4-bedroom, something to note. Another area of concern is that the affordability index is at 45 years to own. Now, we know when it gets into more expensive suburbs that affordability will creep up above 30, but it doesn't leave us much instances, especially with a 5 ERSAD, in my opinion. Like, how much higher can that get at 5 ERSAD? Now, if that ERSAD, for example, was at 8 or 9, then you think that is quite an affluent area and the salaries, there is that sort of discrepancy like you'd have in the eastern suburbs of Sydney, where the affordability might be at 45, but you've got that affluent area and those affluent areas that people are paying to get into. So for here, 5 Ursad, a little bit concerned about 5 Ursad and 45 years to own. Now, first and foremost, one thing I see is demand. 24 days on market tells me it is quite a hot suburb. There's very low stock on market. Stock on market has been decreasing. We have less than 20 listings. Inventory as well is decreasing. Building approvals decreasing. Now the hold period is 14 years, which is exceptional, which tells me a lot of people like to get in and hold in this particular suburb. On the demand side, now days on market for this price range have been pretty consistent between that 20 to 30 days on market. So it tells me that there has been that demand there and the vacancy rate is decreasing. Now, although there has been sort of this spike and increase in vacancy rate, it shows me the last 4 months it is decreasing. We're still sitting at 2%, which is okay. There are circa, 20 odd vacancies on the market at the moment. So I'd want to dig in to have a look a little bit around those. Just one question I would have for this particular suburb was, is there still growth for the people that live in this suburb to be able to buy and afford here if we're at 45 years to own already with only a 5 Ursad? That would be my question to you. That coupled with this tells me that there might be exodus in terms of people not being able to afford selling, that kind of stuff. But it is a little bit worrying. Let's look at it from a geographical perspective. So the zoning is quite consistent in Mill Park. As we can see, there's no real areas for, to get into those higher zoned, more expensive pockets. It's all consistent zoning. We obviously have commercial and industrial. That's fine. Heritage sensitivity. There are some areas around here with heritage sensitivity. Bushfire, as we would expect because of this area here, and if I turn on aerial imagery, we'll see that is forest areas, so I'll turn that off. We can see that that's a forest, so as we would expect, there is some there. There's no flooding. Or any issues like that. Just another thing to note as well, I've just been looking and doing a little bit of study on Mill Park to see that there is planned extensions to the ring road and this road here. There's also another very large easement to go through there. But yeah, a couple of easements in most of the pockets and streets, just something to think about and monitor. Potentially, I don't see easements as an issue. They're just something that you got to note and be aware of. So pretty consistent there. Not too many areas to avoid except for this eastern side. Another cool thing about this particular suburb was when I had a look at the social housing, there wasn't much in Mill Park, which is also reassuring, especially with only a 5 Ursad, which is great. The largest concentration of social housing in this area is right on the southern border. So if I go back to here, and I zoom in, let me just go, get rid of that. Mill Park. So he's right on the border of Mill Park, just down here. One thing also I like about it, Westfields, Bunnings, for those that know the Bunnings theory, lol. And we've got both a state and private school here, athletics, sports, and all that kind of stuff. I think there's 2 other schools too. But something that was cool was that there's very low social housing, even in that one particular pocket. It is only a concentration of 14%. So I would deem that as very low risk. And this could be why the area has seen that growth, is because it has those amenities. It has a distance to the CBD. You do have the shopping centres, the schools, and all that kind of stuff. Would I buy here? Now, the answer is going to be, and the answer always needs to be, is this the best area to spend 800-900 grand in Melbourne at the moment for that long-term hold? I don't think it is. And I can hear you looking at this say, Dave, I know you said it isn't, but tell me why. Well, I'll show you an alternative market that I noticed popped up a couple of times in our searches, in working with some members, in also dealing with and also speaking with guys like Matt Jolich, Taylor's Hill, Victoria. Let's do a comparison in terms of the data. So, first and foremost, pretty similar in terms of let's scroll up to the top. So Mill Park, 950, three betters are around 800k. Taylor's Hill, 750. So very similar price points. Now let's look at the data in comparison. Low risk RCS scores in comparison to Mill Park, very similar. Now, growth rate cycle, as I said, Mill Park has these areas of uncertainty. Now, whilst Taylor's Hill has similar, what we can see here is that even at its worst, Taylor's Hill is still in the positive. It doesn't have that full blowout in negative growth compared to Mill Park. So already there's a bit more stability as well. This has been quite a substantial performer over the last 16 years that this data is available. As we can see, multiple years plus 6-7%. Very good compared to Mill Park. Only a few above 10%, and also those unpredictability in terms of its growth rate cycle. Now this is where it gets interesting. Taylor's Hill, for example, only 9% rented to owner ratio. Volume of 104 rentals and an ERSAD of 8. Mill Park, 5 ERSAD, so lower socioeconomic, and more than double the renter to owners in the area. Now remember, if you've got an investment property and you have, this 30% owner to occupancy ratio, 23%, you have more supply of rental accommodation. It gives people that need to rent more choice. Whereas if you have that lower scarcity, provided that vacancy isn't going through the roof, then it tells me that I have almost the upper hand there, because I know that tenants don't have a big choice to choose from, but they want to get into and live in, want to get into and live in Taylor's Hill. So again, demand profile here, 3-4 bedroom arbitrage, 45 years to own. I compare that to a Taylor's Hill. If I'm buying a 3-bedroom, I have a really good arbitrage, almost double the amount of people looking for 4 beds as there are 3 beds. So already I know that's a quick capital growth play. Here's another thing that I would warm more towards Taylor's Hill. So not only do we have that growth rate cycle, not only do we have a better bedroom arbitrage, if that's what you're looking for, but also 35 years to own, extremely more affordable in comparison to Mill Park. So again, my question is Mill Park the best place to spend $800 on a 3-bedroom home? Well, Taylor's Hill, for affordability, for arbitrage, for growth rate cycle, is still winning. Let's look at the rest of the data. Again, very low days on market, 29, plummeting stock on market. 29 days on market, plummeting stock. Mill Park, 24 days on market, not as much plummeting, but not as much stock. So it tells me that the supply is decreasing a lot in Taylor's Hill. Similar days on market, so it tells me that it's not stock that's getting on there dusty. Vacancy rate, now obviously with Mill Park, 20 odd vacancies, it is sort of decreasing long term. There's been some things happening here with some stock on market. Let's look at Taylor's Hill. Taylor's Hill has had a similar story. However, let's look at the number here. Vacancies. 4 vacancies online at the moment in Taylor's Hill. 4 vacancies. So let's double check that. Okay, so if I go Mill Park, if I just see what Taylor's Hill is doing for rent houses, 1 of 5 properties. So one is there you go. So obviously if I dig in, that's a brand new, that actually looks like an incredible house. Maybe it's overpriced. One's a townhouse. It tells me that there's not a lot of stock on Taylor's Hill, which means I come back to here, the vacancy rate is incredibly low. So for me, in summary, do I think, my honest thoughts on Mill Park, I can see why there is some buyer demand there. There is a little bit of less stock on market. The days on markets are low. There is some vacancies in the area. There is quite a lot of vacancies in the area. Is it the best place if I had 800 grand to invest in Victoria for potentially a long-term hold? I don't think it is. Taylor's Hill is one example that I would give you that I think, in my personal opinion, would be a better investment opportunity. Very similar across some data sets. Taylor's Hill, in my opinion, wins out in terms of capital growth longevity. It wins out in 3-4 bet arbitrage. It wins out on the affordability metric, which I know a lot of people place a lot of value on too. We need the owner occupiers in that area to be able to afford to buy there for it to increase in price. If not, who are the other people that will buy there? The investors. We don't want that. Yes, they may inflate the price, but we know there will be that stagnation if no one can afford to buy there. So for those particular reasons, a better ERSAD, a lower renter to owner ratio, stock is extremely tight in Taylor's Hill compared to Mill Park. I don't think Mill Park is the best place for you to put your returns. However, I can see why it has done those volumes. For me, somewhere like Taylor's Hill is where I'd be putting 800 grand if I'm investing in the Melbourne market for that long term. Again, I don't know what the brief is in terms of buying in that suburb, but this is what I've come to today, my conclusion. Again, let me know your thoughts, feelings, and emotions in the comments, and I'm happy to do a 2.0 or another suburb comparison.